Hello everybody and welcome to Tech Talk here at MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. This is where we take a little technical analysis, looking at some charts, and option analysis where we get an expected move. And I want to take a look at the four major indices that are going to be reporting next, that are trading this week. Right now, off of their best levels, we had the NASDAQ Composite hit a record high. You had the Dow Jones over 21,000. You had the S&P 500 challenging 2,400, and you had the Russell 2000 over that 1,400 mark. So a lot of bullishness, so to speak, in the marketplace, but that's great, but let's give some context. I'm going to actually use the sector ETFs instead of just the broad-based indices, because that's something that most of you will be able to trade more effectively, because they're a little bit smaller priced. They're usually about 1/10 the size of the actual index or market that they track. So for example, I'm taking a look at the diamonds. That tracks the Dow Jones 30. That's DIA is the ticker symbol, down 43 cents today at 209.13. Now you can clearly see from the chart, if I actually just make this a little bit bigger, you're going to clearly see right now that the market's really just consolidating up here. It's pulling back and trading off of its lows right now today. But the point being is that the markets right now can't figure out where they want to go. It bounced Monday, as you can see, and then boom, it just really looks solid going into Tuesday, but nothing. So even though we've had some decent economic data, we've had some good earnings data, especially on the large cap tech side, the market just doesn't know what it wants to do. What's also really interesting right now is the fact that implied volatility, which is a gauge of potential violent moves in the market, it actually is coming out of the market right now. As a matter of fact, when I was looking at some of the positions that I have on for my clients, and in full disclosure, we do have an S&P position on. The one thing that I noticed is that volatility has already come out. In other words, the options feel like they're trading on prices more along the lines of like a Sunday night, Monday. So they're already taken out a couple days of time value out of the options already, or in other words, vol is already coming out too. Taking a look at the diamonds, I use a ranking system called an implied volatility rank. That just gives me an idea of whether or not the options traders are pricing in the potential for big violent moves, or just basically whatever the current trend is, that's what the trend is. And when I look at the diamonds and I looked at the implied volatility rank, it comes in at 7.7. For those of you that have no idea about implied volatility or don't really care, you should take this away. When I say implied volatility rank of 7.7, that's extremely low. It's on a scale of 0 to 100. 0 being basically really no fear, and 100 basically the highest fear you could have of a potential violent move. Now, does that mean it has to go down? No. Does it mean it has to go up? No. It just means that it could have a violent move either up or down. So with that being said, there's not a huge amount of fear that this market, the diamonds, is going to be either going up big or down big. As a matter of fact, when I looked at the options that are going to be expiring next week, they're pricing in a range of about 0.6% on this $200 ETF. That means that basically you could see this underlying either up $1.28 or down $1.28. That's what the options are pricing in going into next week on the close of business, this April 28th, the last trading day of the month. Now, taking a look at the ETF that tracks the S&P 500, the spiders, ticker symbol SPY. Trading down today 47 cents, down 0.2% at 238.13. You can clearly see that, again, the market's consolidating, trading on its lows today, but it's well above its 20 and 50-day moving average. These are technical moving averages that I use to gauge both short-term and intermediate-term traders. In other words, traders that have been trading in the S&Ps and specifically in the spiders for the last 20 days and 50 days. That's a good barometer of a sentiment of bullish or bearishness. That's what I use those moving averages for. Nothing more, nothing less. Now, when I take a look at the options and specifically the implied volatility on the spiders, the SPY options are trading at an IV rank of 7. Very low. So not a heightened expectation of big violent moves. As a matter of fact, the options that are expiring next Friday are pricing in about a 0.5% range in the spiders, in this $238 ETF that tracks the S&P 500. That's a $1.10, either up or down. So you could see it as high as $239.25 or as low as $237.05 next week. Now, that will be challenging some upside and some downside resistance points that we've seen come into play this week. But again, pretty tight range. Taking a look at the tech ETF, the Qs, QQQ, that tracks the NASDAQ, currently trading up 22 cents at 135.97. Now, the Qs have been trading solidly to the upside. Tech has been solidly to the upside. We've seen some large cap tech names have blowout earnings. You see Microsoft. You see, we saw Amazon. We saw Google, all trading up after their earnings. They had solid earnings. Except for Microsoft. Microsoft actually bounced pretty well today. But we see that the Qs are actually trading on its lowest levels today, even though it's still up. It's still in the positive territory. It's trading on its lower levels. And right now, when I take a look at the Q implied volatility, though, it's trading, the ranks coming in at 7.9. That explains why you see this grindy kind of motion. You see this consolidation, but it held that 20-day moving average. That's telling me that both the short, mid, and long-term traders that have been in the Qs for more than 200 days, they're all complacent with their bullish positions. Now, the short-term traders were on their heels for a while, basically almost for February and all of March going into half of April, and then they've taken off in the last week. This is some powerful moves to the upside, but it's been controlled. Tight ranges, very grindy. That explains why implied volatility rank is so low in these major indices. The stocks have not been moving violently. There is no volatility in these markets. The Qs right now are pricing in next week about an 0.8% range. That comes in at around $1.05 that they're pricing in as a range of either up or down. Now, finally, taking a look at the small cap index that tracks the Russell 2000. That's the IWM. The IWM is been trading a lot more volatilely today. As a matter of fact, it is the worst performing index, and this one was the one that was, as I call, the canary in the coal mine. This one's going to be most sensitive as we start to see domestic policies being vetted out. Tax reform, healthcare, those are the things that are going to impact this index. Infrastructure plays. These are the things that if you were wanting to look at an index that's going to give you a gauge or a barometer, or potential red flag or green flag for those policies and how they're moving along, this is going to be the index. It's trading down $1.60 right now at 139.36. Basically, it's 1/10 of the Russell 2000 if you look at the RUT. But at this juncture, the IWM has an IV rank of 6.9. Lowest out of all of the indices. But what's interesting is that it also, though, is pricing in next week the biggest potential move. It has a range of about 1.16% or $1.63, either up or down. Now, it's currently down to 162 today. So it's pricing in, and again, they may be pricing in already next week's move. So we're going to have to watch volatility as we go into next week. We could potentially see a pop with these kind of moves, but it's already moving what they were estimating it would move for next week. So very interesting action in the Russell. Keep an eye on that. Watch the headlines, and we're going to continue to watch the data. Also, I want to point out one, as a little bonus, Apple's going to be reporting next week. And since we're coming into the tail end of the week, you're going to have all weekend to try to figure out some ideas. With Apple reporting next week, I wanted to give you a little preview on the IV rank as well as what the options are pricing in for potential move going into their earnings that's on Tuesday. First of all, their IV rank comes in at 59. So you can see that it's substantially higher than the general market indices. With that being said, the options that are expiring next week are pricing in the potential for Apple to be in a 3% range. That means it could be up $4.40 or it could be down $4.40. That's what they're pricing in going into next week's event on Tuesday. And as a matter of fact, if you go back and look at Tech Talk yesterday, we talked about Amazon, we talked about Google, we talked about Microsoft. Go check out those discussions on what the estimated moves were calculating as far as the options were concerned in the move in the stock going into the event, their earnings this morning. And you're going to be quite shocked with how close, either right inside or just outside those stocks moved, those ranges. It's pretty impressive how efficiently these options are priced. All right, folks, that's it right now for Tech Talk. Join me at 4:30 Eastern, 3:30 Central Time here on MarketStream.live. I'm going to wrap up all the action for today's trading, and we'll see you then.